Hi everyone, I hope you're all doing well, and today we're going to be covering Cineworld stock, which is a stock we actually covered about a month, 2 months ago, kind of a bit more towards the peak of where everything was kind of going into lockdown, and we covered this stock then, and I feel like a lot of people actually viewed that video. I think it's actually the #1 Cineworld stock video that is on YouTube right now, and I think a few people kind of like watched that and have been following me and have now kind of asked for like a little bit of an update into Cineworld and if it's now a good opportunity to go buy the company, because at the time I said that it was a company to avoid buying, and I feel like it's, you know, a little bit of news has come out. It's kind of developed as the, you know, the COVID-19's gone on. Cinemas are starting to open up again now. Is it an opportunity to go buy it now? Because like I said previously, I rate it as not a buy. So we're going to take all the information that we had last time. I'm not going to go as deep into the company fundamentals as what I did on the previous video. So if you want a bit more like into the company side of it, I'm doing more updated news with what's going on with Cineworld right now and seeing that's kind of affecting the company. And then towards the end of the video, I'll be saying if I think it's a buy and what I plan to do with Cineworld. So I think like one of the main reasons we talk about this company is just because of how cheap it is. Now it's a 64p stock, which is extremely cheap. And I don't mean cheap just because of the price. I mean cheap because of how much this stock used to be and now how cheap the stock is. A big massive drop. So we're talking about a 79% drop since May 2019. So obviously you'll know that is like pre-COVID-19. So we knew the stock was going down a fair bit before even the COVID-19. So there was a couple of problems like going on in the company or share price even as well before the COVID-19. But obviously then there was a bit more of a drop as well with the COVID-19. It's the lowest price it's been since 2009, which says a lot. You know, we're buying a company at the prices it was at in 2009. So obviously, you know, you think, where's the company progressed since 2009? And obviously the company has progressed a lot since 2009 in them 11 years. So you're kind of looking at the price now and saying, you know, that says how cheap the company is. You know, you're getting it at what it was valued at 11 years ago. And has the company grown since then? Of course it's grown. You look at what they've done with the acquisitions over the last few kind of years, and the company has more cinemas, more revenue, more earnings. So the company shouldn't really be priced at 2009 prices, which is like one of the first signals that this company has sold off a lot. Now, I am a big fan of the cinemas and Cineworld itself. Like as a customer, I always, you know, I like buying companies that I use, because then I have a really good insight of the company and if they're doing well, what's like the customer service like. And when I go to Cineworld, you know, I think it's a good cinema. I mean, they're trying to refurbish a lot of them to kind of like the new kind of style that they have, where you walk in and it kind of has them reflective floors, them really cool lights that go across it. Like, I think when you walk into Cineworld, they are really cool cinemas, and I think like the viewing experience is really good as well. So like from a customer's point of view, I think the company is fantastic. Like, I think the like what you get from when you use Cineworld, they are a great cinema and a great cinema chain, and I know they're trying to like refurbish a lot of cinemas, so they're all kind of like to the new style, and I think, you know, that will pay off for them as well. I think they're even with the Regal acquisition that they've made in America, they're trying to get them kind of very similar to it, and I think, you know, it creates a great customer experience there. According to Simple Wall Street, it is 72% undervalued. It is a P ratio of 6, so that's really cheap. Like normally I would say like anything under like a P ratio of 5 is a sign that the company's probably a company that's in a lot of trouble. There's a risk of bankruptcy there. Like a company shouldn't be trading in a P ratio of under 5, so obviously with it being 6, it's pretty close to that. And obviously that 6 P ratio doesn't have the you know, what's going to happen with the COVID-19, because obviously it's probably not going to be making profit. Obviously this is taken from earnings that have already happened, but yeah, a P ratio of 6 is a very cheap for a company, so that kind of stands out as well. When you look at the growth, obviously you've got the dip in the COVID-19 numbers, but the growth looks actually pretty good from an earnings point of view, from a revenue point of view. There's some steady growth in this company, you know, nothing crazy, but when you look at the forecast, the growth is pretty good overall, so can't complain too much with the growth side of it. Now this is where the big problem comes for me, and this is where I originally said this is why you can't invest in the company from my point of view, is the balance sheet. This is where it does start to get a little bit ugly from the company's point of view. The debt to equity ratio is 123%. The cash is 140 million, which is really low, especially for a company of this size. They should be having a lot more cash than this. The debt is 3.6 billion. So when you look at that cash to debt ratio, obviously that cash should be a lot higher with that amount of debt, which is kind of worrying. And with the cinemas closing down, obviously it's going to have to raise cash to stay afloat, because it can't afford to stay open with that amount of cash. It'll need a lot more than that. And when I look at the insiders, with a company that sells off this much, what I like to see is normally a company where the insiders are buying like really heavy, because they feel like the company is massively sold off and they'll, easily make money on it. So when I see a stock like this, I always think like there should be a lot of insiders buying in this sort of company, but when you look at Cineworld, there isn't, which is kind of worrying. We want to see people buying at these sort of prices and they aren't, which is another little bit of a red flag. Not a major one, but it's something that I do like to see, that kind of thinks, even the people that have the best inside of the company know what's going on. They're buying with their own money, but that ain't happening, which is kind of a little bit of a red flag. Now, obviously, a lot of this debt does come through the purchase of Regal. Obviously, that opens it up to 500 extra sites. And it was looking at buying the Cineplex deal, which I was a little bit nervous about. I mean, it opens them up to Canada and 165 extra sites, but they were taking more debt on, and that balance sheet's already ugly. So, obviously, with the COVID-19, that deal's been wiped off. Obviously, the Cineplex side of it, obviously they're struggling because obviously they've had to shut theirs. Cineworld are looking like, we're going to have to raise cash, so is it best to do this deal right now? And they've kind of gone, we don't want to do this deal, and it's just kind of fall apart over the last kind of few weeks. It totally made sense for this deal to fall through because it's just not the right time for it to happen. And also, it has had to just raise some money. It just raised, I think it was about £200 million to help it stay afloat, because obviously it was burning through cash and it probably only had a few months of cash worth to stay afloat right now. So it had to raise cash, and obviously there's potential that it does raise more cash. Now, when I look at this company, there is some risk to it. So the risk is of a second wave. Now, obviously, if the second wave happens, cinemas are probably one of the first things that are going to close. Now, I don't think they'll actually get to this point, but if it does happen, obviously cinemas will be probably the first ones to get closed. And if that second wave happens, and with the balance sheet it does have, it's going to be a horrible scenario for Cineworld. The second thing is that there's also going to be restrictions on capacity. Obviously, you're going to have to be socially distancing. That means that they can't fill the cinemas up as much as what they normally do. That means they won't be doing the revenue that they normally do. Obviously, the delay in the films. So you've got major blockbusters that are being delayed to like November. You've got like your James Bond, Black Widow, Top Gun Maverick. They've all been delayed to November. And when you go to the cinema, why are you going to the cinema? It's to see like the big new releases, isn't it? And if they're delayed to November, I think there's not going to be a big massive surge in people going back to the cinema until the big releases come. That means even though Q2 is going to be horrible for Cineworld, I think Q3 won't be that amazing until these big releases come out into November. So that's a big problem, that a lot of these big blockbuster releases, you haven't got new movies coming out at the cinema really until November. So it's kind of going to be a bit of a awful Q3 for them as well, because they won't get them big releases to Q4. So that's something to be careful of as well when looking at Cineworld. So overall, I think this company is a cheap company, and I believe that if it can make it through, the share price is definitely going to go up from where it is right now, because it's at really cheap valuations because of that potential risk of bankruptcy coming in for the company. And also you got that capacity reduction, and also you got the big blockbuster movies kind of not out to November. So it's going to be a really tough time. There's potential that it might even have to go raise more money to get it through to that November period. So there is a lot of risk with this company, but at the same time, if it does make it through, this company has a lot of upside as well. So it is one of those where it's probably a spec play. And I would say that if you are going to buy this, you don't want to make it a big position just on that chance that, potentially you could lose all your money. But if it does make it through and you're buying at these sort of prices, there is a lot of upside in this company. And it's hard to say whether this company is a buy or a sell, but there is some opportunity there. And I think for me, at these sort of prices, I might just slightly wait. And if this company does dip towards maybe 40p a share, then I might be tempted to just have a little bit of a punt at it and see how it does. Because like I say, if it does go up, you're probably going to have 2x your return on it. I think at 40p, if it makes it through, you'd be potentially looking at, maybe even a 3x return. So for me, I think there is some opportunity here, and I might just wait for it to go a little bit cheaper and then maybe buy. But there is a lot of risk, and like I say, I would take it as a spec play and have that theory that there is potential for you to lose all your money and this company goes bankrupt from here. There is that potential with this company, so be careful. At the same time, there is some reward here, but don't make it a huge position in my opinion, because of the risk that it does come with. It does have the reward, but be really careful. And for me, I just want to see a little bit more of the reward really for that risk. And I think if I see this stock drop towards 40p, yeah, I might take a punt at this company and see what happens overall, because if it does make it through, I think you'll see big rewards from this company. And that's me talking about Cineworld today, guys, and updating you with what's going on, because obviously last time I just rated the company as a straight, don't buy it. But now there's like a little bit of potential of buying this company at this sort of prices and getting a bit of a reward. So I thought I'd cover that one today for you guys that have asked me about Cineworld. And as always, smash that like button, subscribe if you haven't, and I'll see you in the next video.